by 2030, women will control more than 50% of the wealth. And if the decision makers are evolving, we need to evolve as well so that there's representation at the table appropriately. And in order to do that, you have to build the pipeline.
This podcast is for advisor use only and not to be distributed to the public. The Wealth Consulting Group is an SEC registered investment advisor, and the opinions voiced and contents in this podcast are for general information only and are not intended to provide specific advice or recommendations for any individual. All performance referenced is historical and is no guarantee of future results. All indices are unmanaged and may not be invested into directly. The economic forecasts set forth in this material may not develop as predicted, and there can be no guarantee that strategies promoted will be successful.
Welcome to the Bull of Wall Street podcast. I'm Jim Worden, the Chief Investment Officer for the Wealth Consulting Group. I'm joined by my co-host, Jimmy Lee, our CEO, and Talley Leger, our Chief Market Strategist. We have some very special guests with us. We have Allison Bonds Mazza with State Street. She's the head of U.S. Wealth. And we have James Seyffart with Bloomberg Intelligence, Senior Research Analyst. Welcome.
Thanks for having me. Happy to be here.
So we want to just start, we're here at an ETF conference. We want to start talking about ETFs.
Imagine
So Allison, State Street's been around a long time. And when I think of ETFs, I think of way back in the 90s when we had SPY. Otherwise, people just call it spiders, you know, to buy the spider. And it was pretty obscure back then, and now we're right around $700 billion. GLD, which came a little later, is close to $180 billion. Can you walk us through the history of ETFs and kind of how we got here?
Sure,
What's the journey been like?
And thanks for having me, and it's wonderful to be here, and what a great location. So, Jim, like you said, it's hard to believe that we're here at this ETF conference, and today, just in the U.S., there's approaching 5,000 ETFs and approaching 14 trillion in ETF AUM, and that's just here in the U.S., and it all started here in the U.S. with State Street. To your point, back in 1993, with the launch of the original ETF here, SPY, and that ETF came out of, actually, the crash of 1987. And the idea that, you know, the regulators realized that there wasn't at the time an efficient way to get market exposure, you know, whether you were trying to buy or sell. And so a lot of smart people got into a room and, you know, think about it, from 1987 to 1993, it took a bit of time to come up with the innovation, but we launched SPY in partnership with the American Stock Exchange. And here we are 33 some odd years later. And, you know, there's this global ETF business, this industry that has totally redefined the investing landscape. You mentioned GLD. We launched that in 2004. That's the OG of gold ETFs. That was super innovative at the time, the idea that you could get exposure to physical gold bars in an ETF wrapper and be able to allocate to gold as efficiently as you do to a stock or a bond in a diversified portfolio. And then the innovations have just continued. So whether it's our sector ETFs or whether it's, you know, our newer innovations in partnership, where we've gone out and partnered with active managers like Blackstone or DoubleLine, or maybe even more recently, Bridgewater and Apollo. The evolution of ETFs are unbelievable, and the point that we have this conference fully dedicated to the wrapper is fascinating. And I don't know that when those smart people got in that room, you know, after the crash of 1987 and for the next, you know, few years, tried to develop this vehicle, that they ever realized how much it would grow and change the face of investing and all of the different applications that people would use ETFs for today. So it's been, what an adventure, you know?
It's amazing.
Yeah, I would say one thing I would point out is the nugget of truth behind the creation of the ETFs actually came out of an SEC report where they were trying to figure out what happened in 1987, and people at the American Stock Exchange were like, we can use this like couple of lines in this very long report, and here we are, full industry.
So maybe, Allison, I could ask you a follow-up question. I know you guys produce a famous flow report. And this is really more of a business question as the jet goes over the podcast.
Did you time that perfectly? Yeah.
I get no respect. I'm the Rodney Dangerfield of the podcast industry. But that's okay. So I wanted to get a sense, maybe we could tease out some areas of strength and weakness in that flows report. And in my own research, I've always found that flows chase returns, not the other way around. So perhaps there's some candidates here that we can identify to do some switching. So where are the flows going to, and where are they coming from? What are you guys seeing and hearing in your conversations?
Yeah, I'll point to a couple of areas that I think we're seeing really interesting flows. And here comes another jet. The first one is really around our sector ETF. So we're actually having a record start to the year with sector flows. And if you probably know, those are originated back in 1998, the select sector ETFs, where you divide up the S&P 500 into the 11 sectors. I think it's really interesting that we're having this record year of inflows for sectors, but 60% of the flows are going into cyclicals. So whether that's energy, materials, and industrials.
Right.
And I think that is, a testament to what's happening in the market today and all of the uncertainty. I just got off a panel where we were talking about gold and talking about this uncertainty premium. And I think you're seeing that reflected in sector flows. What I think is really interesting is around energy. Today, the price of oil is sky high and potentially going higher. Yep. And there's a lot of investors looking, how can we potentially get more exposure to energy? The S&P today is near record lows in its energy exposure, only 3%. And so if you just own the broad-based market, you probably have less energy exposure than you think you do, and you need to kind of bolt back on that exposure potentially with an ETF like an XLE. So the sector flows, I would point out, having this record year, particularly around cyclicals, as investors are kind of tweaking their market exposure in this world of uncertainty. Talking about uncertainty, gold is having another strong year. Last year was a record year for gold ETF inflows. About $50 billion went into US listed gold ETFs. Here comes my jet again. We at State Street saw about 60% of that last year, about $33 billion went to GLD and GLDM. This year, it's another strong start to the year. I don't know that it's going to be another record, but we've seen about $3.3 billion go into US listed gold ETFs. This year we're getting about 90% of those flows, whether it's in GLD or GLDM. So I think that's a testament, Talley, to investors wanting to build more resilient portfolios, more durability, and maybe prepare for what's to come. And then on that theme, I would point out another really interesting flow pattern, and that's with one of our newer ETFs that you guys might not be as familiar with. We launched it a little over a year ago in partnership with Bridgewater. The ticker on it is ALLW, and that is really bringing Bridgewater's time-tested, risk parity, all-weather strategy in an ETF wrapper. And again, like that ETF today is approaching $1.2 billion in assets under management. It's only about a year old, and it hit $1 billion in assets under management before it hit its 1-year birthday. I did a little homework on that because there's a lot of ETFs, and it's very hard for an actively managed ETF to hit scale that quickly. And so, James, you might know this, but last year there were 1,077 ETFs that were launched in the U.S. 15 of them hit $1 billion before they were 1 year old, but 8 of those
Incredible.
were self-seeded or were mutual fund to ETF conversions. Only 5 hit $1 billion before their 1-year anniversary, and All Weather was one of them. And so to me, that's another testament. When you're thinking about the flow report, Talley, that's another testament to what are investors looking for. I want to build more resilient, durable portfolios and bring in asset classes that kind of wig when stocks and bonds wag.
Good point, and well said, Allison.
I've got a question for James. After this jet flies through, Las Vegas is busy. Who says we're slow?
Yeah.
James, do you think the mutual fund industry, was a little slow to the game? Some fund companies that are just now rolling out ETFs, some here actually, and we like those companies, a little slow to the game there. And then what do you see as the evolution of the ETF industry, especially with AI? A lot of talk about the ETF industry actually revolutionizing already What do you think?
Yeah, so I mean, the trend is it's very blatant. There's not even a debate as to what's happening. Trillions have flowed out of mutual funds, particularly actively managed equity mutual funds. Ironically, though, we followed this trend, and the trend was always it was kind of passive to active and high cost to low cost. And that was like going on for well over a decade, and that's where the money was going. And then it kind of shifted, and it's more so from the mutual fund wrapper to the ETF wrapper. As Allison was talking about, All W is a good example, but like really, active ETFs are crushing it right now. They're taking way over their market share in assets and flows. They're way over their market share in launches. The bulk of those launches that Allison was just talking about, I think 85% of them or something around there were active ETFs last year. So I talk about this because active equity ETFs are doing well, but active equity mutual funds as a whole are not doing well. Part of that is because people who own them are just not reinvesting their dividends. Part of it is they're selling to buy ETFs. But no matter how you slice it, money is leaving the mutual fund wrapper in aggregate and going towards things like ETFs, but it's also CITs, more private type of portfolios that are being offered. So no matter how you slice it, that's what's happening. But on the fixed income side, ironically, there was a trend, particularly as rates were rising and people were pulling money left and right. Money is pouring into active fixed income mutual funds. So on the fixed income side, the mutual fund story isn't as straightforward. But on the equity side, it's definitely a lot of money leaving the mutual funds going to the ETFs. And now we're going to have ETF share classes stapled on to different mutual funds to kind of, some of these fund companies, if the money's going to leave, they might as well leave the mutual fund and maybe they can convince them to stay in an ETF wrapper if that's where they want to go.
Yeah, build a moat around their product, right?
Yeah.
So James, I had a question for you about just kind of, again, the evolution. Speaking about the evolution of ETFs, we go through these periods, I feel like there's ebbs and flows where we create a lot of different ETFs. A lot of them get shuttered because there's not enough money that gets in there. But we go through these stages and you know, can you speak to kind of the flows going in and out of asset classes that maybe the market thought, you know, that people wanted but didn't, and then you know, you can piggyback on that, crypto and what's happening with crypto?
Yeah, so I would say a few things. One, this you'll if you've been around this industry long enough, you've heard this term, the spaghetti cannon. I mean, some issuers are way more liberal with what they'll launch, and they will launch. There was a fine the other day from a fund company who doesn't really even have many funds out there at all. That was 88 single stock levered ETF products that they're trying to launch. So a lot of this is the spaghetti cannon. They're just throwing stuff at the wall to see what sticks. Ironically, there's plenty of stuff that I'm surprised, like when they launch, I didn't think they had a chance, and they're attracting billions of dollars, sometimes with very high fees, some of those leveraged single stock ETFs. There's a lot of these structured product ETFs with buffers. The tent is huge in the ETF industry. It's not just taking over mutual funds, it's competing with derivatives, it's competing with trading of single stocks. It's growing and growing. So all of that is, the other thing I would say is years ago, it was like sacrilegious. It was a bad look if you launched a fund and liquidated it. No one has a problem with that anymore. I mean, there are some issuers that are still very reticent to launch new ETFs, but for the most part, people have no problem launching, and now we see ETFs routinely launch and liquidate within a year if they don't see any product market fit. So you end up in this situation where it's just the market decides, capitalism decides, are people buying this, trading it?
Sure.
A lot of it has to do with right place, right time. And on the crypto side of things, I think there's hundreds of filings. We have over 100 ETFs that have been launched in the US. Most of the spot products, they're probably going to stick around. I think we're going to see a whole bunch more products come to market. We're probably going to see a lot of liquidations on the back end of there as well. But if you look at the Bitcoin ETFs, the Ethereum ETFs, some of these other products, despite 60%, 50% pullbacks, if you told me they would see 10 to 15% of their flows leave after a 60% pullback, I'd be like, that's pretty damn good. If you were a manager of a fund and you lost 60% and kept most of your money, you'd probably be pretty happy with that.
Yeah, that's amazing.
So I have a related question for James, and Allison, please chime in too with your thoughts. But at the Wealth Consulting Group, we hold Invesco's Galaxy ETF in our liquid alternatives model. And I bumped into Jan van Eck here at the Exchange conference, and he gave me this cap hodl. So that's their equivalent, their Bitcoin.
Hold on for dear life.
That's right, their Bitcoin ETF. But I wanted to
I'm going to give you one too.
Okay, I'll take it. I appreciate the engagement. But James, I wanted to ask you, for your perspective, Bitcoin has been relatively resilient in this tense operating climate. Some would even say buoyant, and we like to see that in our alternative model. But what's your take? What's going on there, those dynamics, and can they persist beyond the conflict in Iran?
Yeah, so there's a few things here, right? Obviously, they're down. It went down over 50% before anything happened with Iran. It found at least a near-term bottom around 60, and then it's been making higher lows ever since. But a lot of people like to say it's highly correlated to a tech stock. I was on stage talking about this earlier. Most people view it as a high leverage beta tech stock. I think it's a diversifier. What you're talking about, it's idiosyncratic most of the time. There are times, like over the last few months, it's been very correlated to software stocks. That SaaS apocalypse, if you will. It goes in modes where it trades very correlated to different things, one thing or another. So there are times where it's correlated to gold. But at the end of the day, right now, it hasn't actually, it's been mostly a diversifier, like you said, but it's still down 50%. So when I talk to people who are putting this in their portfolio, like you said in your alt sleeve, one, you like to see that it's uncorrelated to other things that are going on necessarily.
That's right.
And two, theoretically, you're rebalancing around that position, right? So if you're buying when it was at 60K before the election and it goes up to 120, hopefully there's a point in there where you rebalanced, and like if your target allocation was 3% or 5%, you went back to that allocation. And then all of a sudden, if at 120 you're at your target allocation, it drops to 60. Hopefully, there's something in there that if you actually are a long-term believer, you're reallocating, upping that again. So, if you're using that and rebalancing around this asset, it shows to really add to your Sharpe or your risk-return metrics. It's very positive, obviously within reason. If you add too much of it, this thing has had many 70+% pullbacks, and if you're going to this asset and don't know that, that's on you.
Yeah.
Thanks for that.
Allison, I've got a question for you. And when we met, you were not the head of U.S. Wealth, so congratulations.
Thank you.
That's amazing.
Yeah.
And last
How long
year,
have we known each other?
it's been a
8,
while,
10 years?
and
Yeah.
actually our firms have built a great partnership over
Yes.
these years, right? And
Yes.
so that's been
And,
awesome.
we've loved seeing you guys grow.
Yes.
All of your success. Congratulations.
Thank you. And last year, we were fortunate to have your CEO, Yixin, on our podcast, and she was awesome. I want to ask you a question about women in finance. So it's been great for me to watch your rise at your firm. And what's your view on that in terms of what the future holds for women in finance in this industry?
What a question. So we are lucky to be led by Yixin Hung, and she became our CEO 3 years ago. When I sort of think about the landscape today with women in finance, I can't help but think about when I started in the industry, now over 20 years ago. Boy, did it look different. And when I started over 2 decades ago, oftentimes I was the only woman in the room. Maybe there would be 2 or 3 others, and that was at the entry level. When you looked at leadership, there were even fewer. And there's been a lot of talk about in order for somebody to believe that they can be something, they have to see somebody that looks like them. And that wasn't always the case in finance with women. And it's not just about women, it's sort of anybody. Like, do you see somebody that is a role model? But I think the industry has evolved quite a bit. Obviously, if we're the 4th largest asset manager, we have not just Yixin as our CEO, our CIO is a woman, our chief business officer is a woman, I'm the head of U.S. Wealth. And so we've made a lot of progress. State Street is the home of the Fearless Girl. We commissioned that back in 2017. Quite frankly, at the time when we did that, we had a lot of progress to make ourselves. We didn't look the way that we do now, but it was really a conversation starter. And today the world's evolved. My personal barometer is my own 3 little girls at home. So I have 3 daughters. They're 8, 9, and 10. They're kind of my daily reminder of what the world looks like and how much progress has been made, but maybe the progress that we still have to make. And I think about when I grew up, I had no idea what a financial advisor was. I didn't know what wealth management or asset management was. I didn't have a role model. And I think about how they're growing up. They'll never not know about this industry. Their mom and their dad work in it. There'll never be a question about whether a woman can lead in finance. A really funny story. Again, I started 20 years ago. I started my career at Prudential Securities, and one of my best friends today is a woman that I started my career with back then, and today she's a super successful financial advisor in New Jersey. And we asked our oldest, our 10-year-old recently, what do you want to be when you grow up? And she said, I want to do what Katie does. And that floored me because she wants to be a financial advisor, and the fact that she even knows what that is and aspires to be it, boy, has the world changed. So all I have to do is look at kind of my own 3 little fearless girls and see the progress that's been made, even from how I grew up, from when I started in the industry over 20 years ago, and then also to see what's yet to come. So I think for all of us, we need to think about the pipeline. And, Jimmy, I've listened to several of your podcasts here, and you've talked before about, and we all know this stat, that by 2030, by the end of this century, women will control more than 50% of the wealth. And if the decision makers are evolving, we need to evolve as well, so that there's representation at the table appropriately, so that women can see that there's, that they are represented at the table with the team. And in order to do that, you have to build the pipeline. So if we want to have really good tallies or gyms in 20 years, we got to have a really good analyst class today. If we want to have women leading in wealth in 20 years, we've got to foster them and cultivate them today. If we want to have the next Yi Shin Hung leading one of the world's largest asset managers, we better be hiring those type of people, today. And so to me, that's kind of how I'm thinking about it from a hiring standpoint. I think we all in this business need to think particularly as sort of these demographic trends are shifting.
That's great. You actually answered it. I was going to ask you a follow-on question, what firms like us can do to promote more of that, but I think you gave a good answer. But is there anything else that you want to add to that?
No, I just think, I always kind of think like the 7 Habits of Highly Effective People, the one that is one of my favorites is begin with the end in mind. Mm-hmm. And if we want to have the next Yi Shin Hung in 30 years, what do we have to do today? And so it's that pipeline.
Thank you.
So I've got a question for both of you, for Allison and James. We've seen a lot more active ETFs come out, and I know with State Street, for a long time it was just passive, but we've seen Blackstone and Apollo and now Bridgewater, and I know, James, you're looking at all the flows here. Does that trend continue to that we see more active, or are we going to see some more indexes? Because I know some firms come up with their own ETF and they have their own index. Where is the trend heading?
Well, I think James called it really well in his opening comments around just the growth of active. And I'd point out, while we created the world's first ETFs, and for a long time they were mostly passive, we were actually an innovator in active ETFs dating back to 2013 when we partnered with Blackstone to launch SRLN, dating back to 2015 when we partnered with DoubleLine to launch TOTL, and then some of the ones today. James can talk chapter and verse on this, but when we talk about active ETFs, industry definition is really just anything that's not passive. And so I think for those of us who've been in the industry for a bit, we think of active as like these traditional active managers, the legacy mutual fund managers who are now doing a share class conversion or are just kind of joining the ETF party. But active in the ETF industry is just anything that's not passive. So it's these derivative income, defined outcome, options overlay, buffered, single stock, leveraged and inverse. Maybe not necessarily what your average bear would consider active. But I think that is definitely where the industry is headed. And James, I'm sure you have a lot more to say about that.
Yeah, we call those active in name only because they're technically active as far as our stats show, but they're not in what people think of as like an active stock picker sitting there and trying to pick stocks and outperform the market. That said, one of the big trends we are seeing is like people are right-sizing their fees for what they're doing with active. If you're high concentration, uncorrelated to a benchmark, you can charge higher fees. And we're seeing mostly advisors like you guys, you're not willing to pay 1% for somebody that's barely deviating from the benchmark because you can get the benchmark for free. And we think there's been this growth of advisors and investors that understand the phrase we like to use is like, if you're getting a bag of chips, you don't want to pay for the air. You'll pay for all the chips you want. But if you're going to give me high octane active, I'll pay up for that. And there's plenty of these legacy asset managers who are, you said some of them are coming late to the game, right? But they're coming and they're putting a lot of weight behind them. They have a lot of weight behind them and they're right-sizing their fees. They're not charging 1%, but they're because they're not super differentiated from the index, but they're charging in the 30 basis points range, 20 basis point range, and advisors are willing to pay for that if they think they're going to outperform over the long term. So I think the growth where everything is going is active. Even products that are mostly systematic and sort of index based, a lot of people just feel safer putting them in an active ETF wrapper because they can tinker with things when they have to.
Yeah,
So
that's super helpful.
we're near the airport, and you just prepped the runway for the next question.
Great
And it's-
segue.
Right?
Good job.
Thank you for that. And so this is kind of a related but long-winded question, and I want both your takes on this. Maybe we'll start with you, Allison. Given that you're an executive in the wealth management space, you run wealth management for State Street. There's an issue here that I've written about, and I'm trying to help WCG advisors with, and we call it the advisor margin squeeze. Okay, so we know the industry has this kind of static 1% fee problem. Meanwhile, pricing power for portfolio management and advice has increased about 50% over the past 5 years. So we're leaving money on the table when it comes to our own pricing power as advisors. Meanwhile, on the other end, the input costs are also rising. We've got expensive legacy investment management expenses. We've got technology software inflation. We've got rent inflation. There's rising support staff costs. So we're getting this kind of classic margin squeeze from the top down and the bottom up. So what would you do? What would be some of the solutions in your conversations for advisors? Like, for example, how do they have that difficult conversation with clients about raising their fee because of the broader scope of services and, quite frankly, the 50% higher assets now that they are managing? And what would you say perhaps on the legacy kind of investment management side? How can we lower our costs to reclaim our fee?
Well, I'm going to answer that in a couple of ways. The first one is firms like us at State Street. We've worked hard over the years to try to actually lower our costs to make it easier for you to build diversified portfolios and to think about where you're spending your risk budget. And James talked about active management and some of them charging 30 basis points and up. We've got our SPYM ETF that's 2 basis points for the S&P 500. So, and we're constantly evaluating and looking and trying to, we're all dealing with fee compression, but trying to be really good asset management partners and lower our fees as we can, so to provide you with the tools that you need.
That's great.
When I think about the value of advice and obviously costs are. When we started this relationship, we were doing A and B, and as our relationship has evolved over the years, maybe even over decades, as you all have had these clients, we're now doing A, B, C, D,
100%.
and E. And it's not a secret that there's inflation and the cost of everything is going up. And as you were asking the question, I was just thinking, I've been reached out to for a bunch of different services over the last, call it quarter, about, by the way, you're coming into the dentist and we just want to let you know that our price has gone up, or you show up at the doctor's office and, by the way, you're here for your appointment, just to let you know it costs more than it did last year, and you just kind of go with it. So I think it's hard to have those conversations, but the more that you can show the value that you're adding, and particularly when you started the relationship, you were just doing a handful of things, and as you evolved it and provided more planning and services and advice and all of the things that you all do, really around handholding and helping people not make bad decisions and stick with the plan and not let their sort of behavioral biases take over. I think that you deserve all the fee in order to do that, because you're sort of helping people achieve their dreams.
Yeah, I would add one thing, which is not directly related to the wealth manager, but more to what we were talking about before with outflows from the actively managed equity mutual funds or equity mutual funds in general. Even passive equity mutual funds are seeing outflows. If you look, it's like the best business in the world, because they are seeing trillions of dollars in outflows and their assets are still rising, which means their revenues are still rising. So we call it the bull market subsidy. So one of the benefits that wealth managers, asset managers, if you get to a certain, I guess I would call it escape velocity, as long as your outflows aren't going out at a greater proportion than the market is going up, your revenues are actually going up. You got like this inflation hedge. So we call it the bull market subsidy because it's like one of the best businesses in the world because you can see your customers leave every month for years on end and your revenue is still going up. So, and I would say the ETF industry on the flip side is doing the exact opposite, particularly on the passive side. I mean, fees are being driven down extremely low. Allison mentioned SPYM. I mean, 20 years ago, if somebody told you could get the entire S&P 500 for 2 basis points, and ironically, it's probably even less than 2 basis points with the tracking difference when you look at some of those things, particularly in small caps, you get near free exposure in an ETF wrapper and it's fully liquid. So these tools are fantastic. And the other thing I would say for the ETF industry as a whole, right now, the asset-weighted fee, we bottomed out around just under 17 basis points globally. So it's really cheap. ETFs in the US, specifically asset-weighted, the fees were below 17 basis points, which is really good. But actually, over the last year and a half, that number is ticking up because of the stuff we're talking about active. A lot of money's going into those people charging 20 to 40 basis points, not just the stuff charging 5 basis points. And we're also seeing a lot of those spicy, hot sauce type ETFs, as we like to call them, the buffer products, the single stock levered ETFs, charging 85, 100 basis points. And that's basically driving the asset-weighted fee of the ETF industry up, which I thought might be an interesting thing to point out here.
Totally, and what a change in the trend, right? Because for many years, most of the flows were going into those ultra low cost ETF, low single digits, and now with the advent and sort of the progression of active ETFs and that trend higher, to your point, the overall expense ratio, the average is higher, and that to me that's a real shift because there was a time when it was a race to zero, and now it's we're seeing interesting ways to use ETFs, and investors are willing to pay 80, 90 basis points for them.
Yeah, people, it used to be just building blocks, and now people are buying full-blown solutions, whether it's covered call overlays and things like that Allison mentioned. People want income, and there's products they'll pay up if somebody will do it for them. They'll pay up for convenience.
Yeah, or for a defined outcome.
Yes.
To have a known outcome range.
As the ETF industry continues to innovate and you get more sophisticated products in these retail chassis, how do you guys feel about that? I mean, so the talk right now about private credit, I almost think it's our fault as financial advisors sometimes where in some of these interval funds where there's liquidity, we're trying to get our clients' monies out and maybe we're the ones that are unsophisticated, whereas the more sophisticated product structures keep the clients in, right? Which is what's supposed to happen in that asset class. So it's interesting from an asset manager's view. I'm assuming you guys want as many products possible to get to the marketplace and democratize that kind of business. What's your guys' view on it from Bloomberg Analyst standpoint and also from a product manufacturer ETF?
Yeah, we actually argue about this on my team. So we have a team of people who cover this, and some of them have very different views. My boss, Eric Balchunas, is very much like put everything in the ETF wrapper and let it get sorted out. Because honestly, that's where the fish are biting. That's where the fish are jumping in the boat. But some stuff probably just isn't the best to be put into an ETF wrapper. I think interval funds, BDCs, those types of things, where it's trapped capital, yes, you get trapped, but theoretically, if you're going in and there's a cap on how much money can be taken out every quarter or what have you, it's probably a better structure for that underlying asset. It's just that there's not as much money, even despite that. People much prefer, even if you put private equity, private credit, what have you, in ETF wrapper, people like the daily trading ability of it, and they don't care if maybe it's going to trade at a massive discount or premium for the most part. Whereas I think it probably is better off in those more structured wrappers that tend to have higher costs and other sort of illiquidity issues. But I mean, Allison could probably talk a little bit more about private credit and ETF wrapper than I can.
Well, I think there's a couple different ways to think about it. We at State Street are always looking to democratize investing, and we don't think that you should have to be an institution or a super high net worth investor to be able to access Ray Dalio's, time-tested risk parity all-weather strategy, as an example. But assets under management, and we're really thoughtful about if our name's on the tin, what's in it, and so. There's a lot of different ETF product types that we've talked about today that we just don't play in because we're not comfortable in that space. But that doesn't mean we're not trying to democratize investing. And so we're always looking. We talked about gold, at the beginning of the conversation. That was super revolutionary at the time. We'll continue to try to do that, but at the same time, taking a balanced approach and really thinking, our name's on the tin, how do we do this in a thoughtful way, trying to make sure we have good outcomes, and also really cognizant that our clients are everyone from the largest institutions in the world to financial advisors and RIAs to end investors and everything in between. And ETFs can be bought by all of them. And so that's also something that weighs heavily on our mind when we're doing product development.
Good answer.
So I've got a question for both of you really about using ETFs and models and how advisors do that. We spend a lot of time in research and look at analytics and building models, and now I feel like there's so many different ways to build models. Some people can just buy a couple tickers and that's their model. Some of them will try to be a little bit more tactical. What are you guys seeing in terms of how advisors are building model portfolios? We'll let the jet pass. First to James and then to Allison, because I feel like there's a lot of ways you can build really good portfolios with ETFs now that before you couldn't do that.
Yeah.
I mean, let's be frank, there's trillions of dollars that are tracking model portfolios, whether it's directly or it's on them to trade it. And it's if you're an indie issuer per se, if you can get into a model, it can make or break your business for literally years or period at all.
Sure.
So I mean, we like to call, back in the day, the only real model that was moving things was Merrill Lynch. So Merrill was the original provider of this, and we used to call it Bigfoot because you would see these giant inflows in one ETF and out another, and it was
Love
like
those.
looking at Bigfoot steps. And now we see it, and it's like there's just too many to know what's going on. So we would see something, we know that was the Merrill model portfolio.
Sure.
Now we see stuff, it's like, was that BlackRock's model? Was this somebody else's model?
Was it Schwab?
You don't really know who it is, but you know for a fact it's underlying. It's like the current that's moving things going around. So we try to watch it. We are, as a team, are looking at potentially doing more coverage of exactly what different model portfolios are doing. But I mean, as advisors, for you guys, a lot of the stuff from the advisors I talk to, they'd much rather outsource the investing side of things, put their clients in model portfolio, work on them with the financial plan, work on them with all the other things, the legacy planning and all that stuff, and they can kind of outsource a model portfolio to someone. And in many cases, the model portfolios are free because they're going to stuff it with mostly their products. There are plenty of independent models, but if you're just going to go to an issuer model portfolio, it's going to be stuff with most of their ETFs. A lot of them actually go to other ETFs as well, and their fee is actually just you putting assets in their products. And I think it's very symbiotic.
Interesting.
Yeah, I'll just build on James's comments. So if you think about models, we think about them in a few different ways. The home office models that he referenced, the Merrill CIO model still being the biggest, but there's many others, and you are sort of always trying to get an allocation into those. Financial advisors running their own models, whether becoming PMs themselves and using ETFs. We at State Street have an investment solutions group that runs models as well, tactical or strategic asset allocation models. And a lot of times advisors, OSJs, RIAs will come to us and say, can we white label a model, or can we kind of create a custom model? That's probably the biggest area of growth that we have right now is this custom model. So not necessarily our off-the-shelf models, which are great, but people wanting to put their sort of fingerprints on the model. One of the things that we've done over the last couple of years is partner with what I would call model providers, one of them being Envestnet. So we made a strategic investment in Envestnet, the largest TAMP in the industry, now about a year and a half ago. So we're a minority investor and also one of 4 premier partners, really in a way to help advisors build model portfolios and UMAs. So not just kind of your ETF models, but adding on SMAs, direct indexing, tax overlays, sort of that evolution of models. And then the other thing that we've done over the last year is make a strategic investment in a partnership with this firm called Ethic. And I don't know if you've heard of them, but it's a wealth platform that, again, really helps RIAs build customized model portfolios at scale. And to James's point, if advisors, RIAs want to partner with us on Ethic, they can get the technology for free if they have a certain amount, of State Street products. Now, I actually think the evolution of models, it used to be, like you said, it was a State Street model, it was all State Street. It was a BlackRock model, it was all BlackRock. JP Morgan, all, that doesn't exist anymore. They're all, we're all kind of using, nobody wants 100% of any one asset manager, nor does any one asset manager do everything the best. And so there might be a State Street model that's mostly State Street, but it has some other asset managers. And I think every other asset manager is taking that approach now as we've sort of seen this evolution. So huge growth trend in models, many different ways that we're seeing that play out across the ecosystem.
So as a group, we were just talking about the flows from active to passive vehicles. And I wanted to kind of take it back to more of a kind of a general theoretical and practical question. One of the personalities we've had on our pod as a guest is Mike Green from Simplify, another one of our important partners. And we were talking about this, given the changing structure and composition of the market. So from active to passive. We know that active managers keep cash. They like to have cash ready on the sidelines. Meanwhile, passive abhors cash. It wants and looks to be fully invested. So my question here, it's really a hypothesis. What do you think? Does that, given that composition and market structure, does that create kind of an underlying bid to stocks? Does that raise the floor underneath the market? And does that mean that we have now less sensitivity to price because of that underlying buying pressure? And what does that do to valuations? Does that mean that we should ultimately expect a higher and higher multiple or valuation for stocks over time? And ultimately, does that mean that the classic retail strategy of buy the dip is alive and well here?
What do you think, James?
You want me to go
Yeah.
first? I can go. I've debated Mike on this many times. I agree with a lot of things that Mike says. My view on this is like, just look at the last 6 months. I mean, if it was truly controlling the market, I mean, fully controlling, we wouldn't see the Mag 7 underperforming. We wouldn't see the energy stocks, the industrial stocks, the material stocks, natural resources stocks all rising the way they are. I do think there is an underlying almost current that is helping the names that are the largest names in the indices, like the S&P 500, most likely. I think there's been enough academic reports and white papers out there that kind of support this thing. But at the end of the day, I kind of view it as like, this is just how the market works right now. And if you believe that it's completely distorting it, bet against it. I know Mike is actually doing that, and he's creating products that can kind of try to take advantage of the things that he thinks are happening. But the market, the active managers tend to take over. They decide what the weights are of these names in these indices for the most part. And you see names that get kicked out of indices all the time because of idiosyncratic issues with those stocks. It's not like, GE was doing well or horribly, and the passive flows that were going into that product kept it in the index. All these things, names are kicked out, put in all the time. It's still dynamic. At some point, might it become a bigger concern? Maybe. But from my point of view, I think, yes, there's an underlying drumbeat that's helping it potentially. But active managers still, at the end of the day, are able to take control, particularly around like earnings releases and things that are happening with individual company. And we're seeing it right now play out in the fact that we're seeing these things, these real assets, not just the technology stocks, do well.
Good point.
James, I got a question for you about AI. I was trying to ask earlier, but how do you see AI playing into investment management, whether it's the ETF product chassis or something else? How do you see this evolving? I
mean, there's two really broad ways that we're seeing it play out in the ETF world. One is you're actually using AI to pick stocks. There's actually been AIEQ is one ticker, but there's been a few ETFs that are saying like, we're using AI to pick stuff for like 8-9 years now. They're still around, they're doing okay. But the ones that are really successful for the most part are the ones like playing on the AI theme. They're getting a lot of assets, investing in the picks and shovels of the AI ecosystem. Obviously, plenty of people are very interested in that. Software stocks right now have been absolutely destroyed by the theory that AI is going to destroy software needs, drive the cost of making software to near zero. But like from an ETF perspective, those are the two ways that I'm paying attention. And honestly, on the AI stock picking side, there's not really all that much happening from my point of view, but maybe I'm not really in the weeds on that side.
Allison, how do you see it working at your company?
Yeah, well, I think about all of us sort of in the advice or wealth management or asset management industry, and there's obviously been a lot of chatter about AI. And I think we need to acknowledge like what AI will help with and maybe like what it won't. And so obviously it's going to make everybody more productive. It already is. And obviously you're going to be able to do analysis more quickly or it's going to improve coding or all those things. And I think there's a really interesting shift between it used to be you wanted to be a coder, right? That was what people were telling their kids to go to college for. And now that's the opposite of what you'd want to do. But I think what it's never going to replace is the human connection. And I think it's a relationship business, and particularly managing people's wealth is personal, and it requires trust and hand-holding, and you can't do that with a machine. And so when I think about the evolution of AI and sort of what all of our seats and hiring, if you are a hirer of talent, you're no longer looking for people who could be a great coder. You're looking for people who can be great at client facing. And you're looking for people who have EQ. You're looking for people who can build trust. Because I don't think that's going to go away. I actually think that's going to become more important than ever. And we're going to have to sort of build the next generation to be better at that than ever. And that's going to be hard because everybody's using AI, right? So I think that's what we need to figure out is how do you create apprenticeship and training around that? And when you're hiring, thinking, can this person build relationships? Can they communicate with clients? Do they have empathy? Can they build trust? And how do we even build on that skill set? Because I don't think AI could ever take away the importance of that, particularly when it comes to managing people's money, because it's so emotional.
It's funny, during COVID, I remember everyone was like, in-person meetings are going to be done. No one's going to be flying around the world anymore.
Yeah, and here we are.
It's accelerated because everyone's like, we need in-person interaction.
Sure.
And I wanted to add Bloomberg. Like, I use AI every day, pretty much, because we're building a lot of tools on Bloomberg, and it's helping me code. Like, I was an okay coder. I could work in Python. With AI, I can actually build a lot of cool stuff on the terminal. And one of the biggest initiative right now at Bloomberg is we're creating an AI tool. It's called Ask B. So, like, everyone is going to be playing around with this. Who knows how successful all of it will be? I'm sure there will be failures and successes, but like with Bloomberg within our company, it's probably priority number one right now.
By the way, we love doing interviews at Bloomberg in New York because all the free food and coffee.
Yeah.
I'm on with Tom all the time, Tom Keaton.
Well, and I just have to say, I'm using the terminal, and I'm starting to use Ask B, and like it's powerful. I think that as Bloomberg fine tunes that, it puts more in the hands of the users that can leverage whatever that is without having to send a message to the help desk.
Yeah, and without having to know the 30,000 different function names. It's getting better if you need help doing like very specific things on the terminal. It's really, really good. If you ask broader questions that you probably would be better off asking ChatGPT or Claude or what have you, but for the most part, Bloomberg specific stuff, it's actually like exceptional.
That's awesome.
So I've got one question for both of you and for anyone who wants to comment. While we're on the topic of AI, not so much with ETFs, but does this become something that might be disruptive to direct indexing or custom indexing? I mean, if clients or advisors at some point in time can just say, hey, I want to build this, and they can do it all without having to go to all these different direct indexing providers. What do you guys think?
So we've been kind of bearish direct indexing versus ETFs because we were told many, many years ago at conferences like this that they were going to be the ETF killer.
Isn't it funny, the theme,
Yeah.
right? COVID's going to abolish travel.
Yeah.
Tokenization is going to kill ETFs too.
Yes, direct indexing is going to kill ETFs, right? So it's all these themes, yeah.
What ends up happening is direct indexing is now actually using ETFs in some cases. There's specific use cases where direct indexing actually crushes the usage of ETFs, particularly if somebody has like, you guys know more than I do. So I think of it as like a small portion of the assets that are going to get allocated there. But anything you're using with technology, if AI is actually going to get better, it's going to drive down costs of doing it and bring out competitors. But anyone who has a direct indexing product, I think it's more likely that they're going to implement AI type technology in there and make their product more efficient, better, what have you. But I don't know. This is out of my wheelhouse of expertise.
Costs go down.
Yes.
Right.
Yeah.
Yeah, costs are going to go down. It's going to be more productive, more efficient. But I still can't help in any investing think you could use AI to build a direct indexing product or a model, but when times get tough, are you going to talk to a machine and are they going to say, stick with it, Jim? Or like, this was your plan, let's remember. Or, I just don't see them doing that hand-holding.
Sure.
So I wrote a book about investing using exchange-traded funds a long time ago. I've been an early adopter, and it was essentially a sector rotation model designed around your spider sector ETFs.
Okay, I love it, Talley.
So, shameless plug for
Yes.
both of us.
Okay. I'll pay you after.
That's right. So I want to thank you for your product innovation at State Street. But bringing it back to WCG, we own a sizable position in the industrial sector. And I'm a personal fan of XLI, just to name one of the products. And I think on one hand, it's a great play. It's been serving us well on the U.S. manufacturing renaissance. That's kind of blossoming here as we speak. But it's also getting support tactically from the war through defense stocks. And so I kind of wanted to ask you, do you think those tactical and strategic themes will continue? And maybe beyond industrials, what's another way you might play those same themes, thinking about the building blocks required for the build out here in the U.S.?
Yeah, I think in this market environment, we'll continue to see people doing what you're talking about and sort of tactically adding on based on themes. So maybe having your core exposure, but given all of the uncertainty and the geopolitical conflict, what's happening in Iran, XLI is one of those three that I mentioned, was driving these record flows this year that we're seeing in our sector products. I think we're also, every time the president talks, we see flows into the aerospace and defense. So, I think people will not only use the sector ETFs that we talked about, but drilling down into the specific industries and try to sort of play that. And again, when somebody double clicks into their broad-based market exposure, using the S&P as an example, I think they'd be surprised how much is in tech and how little is in some of these more cyclical industries. And I used energy at the beginning, talking about how it's only 3% today. In the 80s, it was 32, 33%. So those sectors do move around. You have to know what you own, and given what's happening in the world, do you have enough exposure? And we do see people, again, these record inflows into sectors, and now even more so into some of the industries, trying to build back in exposure that they don't have currently.
One more question for you about your company specifically. You and I were speaking in Miami last week at Future Proof about how you've been involved in a lot of deal-making conversations because of Yishin and her background. And how about you guys? What are you up to in terms of product innovations or new things that, yes, you can talk about?
Okay.
What should we expect coming out of State Street?
Yes. So Yishin does have an investment banking background, and she's created a clear growth mandate for us at State Street. State Street Investment Management's been around since 1978. Unbelievable institutional heritage, a pioneer in indexing, and she has really come in and created this bridge to the generational trends that we're watching and observing around wealth and advice. And we have made a number of investments. I talked about some of them with Ethic and InvestNet, but they're not just here in the United States. We've made some investments globally, all in a way to sort of expand investor access. So we're a minority investor in a firm called PensionBee out of the UK. We are a minority investor in a firm called Raise out of Australia. We're a minority investor in a firm called Small Case out of India. And so, I just listed 5: Ethic, InvestNet, Small Case, Raise, PensionBee, and there's more.
WCG.
You're next. Yeah. So, I think we have really focused this sort of growth mandate, this growth ambition around partnership and investing, not just here in the U.S., but also around the globe, again, in this effort to democratize investing, expand investor access, and make it really easy for people to do business with us. So trying to, again, lower the cost of ETFs, partner with firms like Ethic and InvestNet, where advisors are building models and making it, super easy to be a great business partner and ultimately be an indispensable business partner.
That's awesome. James, from a financial advisor standpoint, I've been an advisor for multiple decades. What advice would you give us here at this conference from your seat?
You want me to give you advice?
Yes.
I need some investment advice. I need some asset allocation advice. Honestly, like the main things I hear are one word I love is conversational alpha. being able to just talk to a client about an interesting thing that you're doing to the portfolio. But for the most part, I think most people are just happy to, like Allison said, have somebody to call. My parents are in the process of looking for an advisor actually right now. And so like finding the process of like finding somebody they can talk to and they actually enjoy speaking with and isn't going to charge them 150 basis points on their AUM or anything along those lines. So for the most part, I think what I'm seeing is most advisors are being cost conscious with their investments, and the margins are getting squeezed everywhere in this industry right now. Technology is hopefully helping some of that, but yeah, I mean, for the most part, my advice would be use more ETFs, lower cost ETFs, and you get more margin for yourself. But obviously, a lot of people like the active side of things as well. So, but yeah, I don't know if I'd take my advice on how to run your business if I have to be honest.
Well, how about this from both your views in terms of the children that are going to generate all this wealth over the next 10, 20 years, right? For the baby boomers and older. Do you think those investors are going to be different than their parents were?
100%.
They're way more nihilistic. Like the younger than, I'm a millennial, an older millennial, I guess, but Gen Z, they are like so nihilistic about the way they view things. I don't know. One piece of advice would be to understand what's happening with tokenization. I mean, it's far out. It might not actually be as big as some people think. I think it's going to be a big part of this, but being able to talk about the things going on in the forefront of different industries can go a long way.
And I would say also just being comfortable being digitally native. If you think about sort of that next generation, that they're so comfortable digitally.
Sure.
And I think, not Wealth Consulting Group, but there's a lot of advisors that maybe need to brush up there if they're going to capture that sort of that next gen wealth transfer.
Sure. At most financial advisor conferences, the advisors are a little bit older, right?
Yeah.
And
Yeah.
I think our president was just on a panel talking about M&A. I think a lot of the older advisors are actually happy to potentially cash out in the next few years because dealing with all this new technology, AI, I think could be very challenging for a lot of people.
And kind of going, you asked James for advice. I'm going to give you some unsolicited.
Yes.
Like if I think about it, and you sparked the thought, was when you think about your own succession planning or just building out teams, making sure that you have different generations within your team. That, again, we talked about women and representation, but it's not just women, it's just generational representation so that people, again, can look across the table and feel like they are represented and feel like someone gets them. And some of the best teams and firms that I know do that really well, and they'll have an advisor in their 60s, in their 50s, in their 40s, in their 30s, and even in their 20s. And they learn a lot, again, about sort of the digital part from those 20-somethings and how they think. And so I think we would all be remiss to not do that and sort of listen to what they have to say and how they think about the world and what's important to them, because they are going to be the ones, getting all of this wealth.
Jim, I'm the timekeeper, and you've got to go on a panel talk about bonds here in a minute. Talley, you have one last question for these guys?
Yeah, so James, I actually remember, this is a fun story, easy question. I had dinner with your boss, Eric Balchunas, in New York years ago when we were lighter and we had less gray hair. It was with Sarah Eisen.
You don't have any gray hair. You don't have hair.
I don't have hair. That's my point. It was with Sarah Eisen and Scarlett Fu back in the day. But I wanted to ask you, because he's not here, I guess he's not able to defend himself, but what's he like to work with, and how long have you been at Bloomberg?
Oh my gosh, poor James.
Oh
James,
God!
how are you going to do this?
This is recorded, unfortunately. Yeah. No, I'm just kidding. Great. I interned at Bloomberg right out of school.
Yeah.
And did a project on ETFs. And when I came back, I had a full-time offer, and I wanted to work on ETFs and hedge funds. So I worked in data, and then I joined him in Bloomberg Intelligence to write research. So I've been there. It'll be 12 years in June, and I've been working with him in some way or another the entire time, and now he's my direct boss. So it's all good. He's got the TV show, we got the podcast. This show is now an hour long, so it's all good. Nothing bad to say, honestly.
I love it.
Yeah. I'm trying to think of something funny or quip to say there, but honestly, it's great to work for, genuinely.
That's awesome.
Well, this has been fantastic. Thank you so much for joining us, James, Allison. This has been wonderful, educational, hopefully for everyone who's listening.
Yeah,
Right.
super fun.
Thank you, guys.
Thank you.
Thank
Good luck on
you.
your panel, Jim.
Okay.
Thank you.
Knock 'em dead.
The hard question I have for you, and I'll always ask someone because they'll complain about drug prices, and I'll ask them, what day is it that you want to die? Invariably, the answer is not today. So healthcare is going to be expensive because it's the one thing that you totally need is to be alive. And that's it. So there will always be a great desire to live well, live better, and live forever.
Yeah.
And that's all of our goal.
Yeah.
That's it. When are you dying? When are you checking out? Never. My grandma lived to 100 years old. I want to live to 200.
I love it. This has been so fantastic, Mike. Thank you so much for your time, and Paisley, thank you for helping with this.
Of
And
course.
I really enjoyed our conversation.
Hers and his, three's company too. Come and dance on our floor. Take a step that is new.